Hi. So we're going to be looking at a very critical point, critical topic in the Exploring Management Accounting module, and that has to do with marginal costing and then break-even analysis. Some books will not use the word break-even analysis. They will use the word cost profit volume analysis, and it's the same thing. Okay, it's the same thing. So we'll delve deep into these particular topic and see how best we can explore its benefits. Great. All right. So maximizing my slides. Okay. Great. 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 All right. So we're looking at relevant costs. These are things we looked at during our tutorials, but we're looking at it again, just a quick overview. And then we construct a marginal costing statement, after which we'll look at a contribution analysis in terms of limiting factor and contribution per unit. And then we'll look at operating gearing. US books will say operating leverage, the same terminology, okay? And then we'll look at a break-even analysis and then operating gearing example, a typical example of an operating gearing scenario. Okay, great. Now let's walk into these and see, just to be sure my video and audio is working, because I've had, okay, great. I think we're on track. Okay, so we delve into relevant costs. So any cost which concerns the future, business decisions are usually about the future. Any cost, future costs which will be incurred as a direct result of undertaking the course of action is deemed relevant. So any cost which will impact on our current cash flows and which also has any impact on future incremental cash flows is a relevant cost. Okay, it's a relevant cost. All variable costs are relevant costs. All variable costs are relevant costs, and they are avoidable costs. So in other words, all relevant costs are costs we can avoid and use an alternative means to achieve similar or the same purpose. All right. But those costs that we cannot avoid, which has already been incurred, are irrelevant to our future decision making. So the opposite of irrelevant is irrelevant, like I said, and not relevant because it does not impact on our future direction of the organization. Neither does it result in any course of action for the organization, nor does it result in any future cash flows or incremental cash flows to the organization. And they are not avoidable, okay? They've been incurred and it's already plunged the company into certain situation we cannot do anything about. So fixed costs are irrelevant costs. They are unavoidable. You need to incur it, okay? They are unavoidable. Opportunity costs are relevant costs. This is a key term picked from economics standpoint of view, and it normally looks at we pursuing a course of action, whereas we end up sacrificing the gains or benefits for the other. So we forego one line of action in order to take up another line of action. We have 10,000 pounds. We can use it to build an extension of the factory. Instead, we decide to use the 10,000 to invest in stocks. Okay, so we forego the production benefit from the extension that would have undertaken on the premises, and we're rather going for interest on the securities or on the financial instruments. Sunk and committed costs, they are irrelevant. So they are normally costs we've incurred, they are gone into the system, useless. Let me use that word, useless costs which do not impact that. Don't use the word useless, okay? They are not really useless as at the point we were incurring them, but currently they are not relevant to our decision making, okay? So these costs are irrelevant, they are historical, they occur in the past. So reset costs usually, when it doesn't result in development, are sunk costs, okay? Committed costs are also incurred regardless of whether a course of action will be undertaken or not. So both costs are not relevant. In constructing our marginal costing statement, we normally will have to use the fixed cost and then the variable cost and split them up to come up with a key term called the contribution. Okay, so you can see this terminology, contribution. In accounting, is principally profit. Okay, it's the same as profit, but in management accounting, we want to use the word contribution because the main idea is that when we have our sales figure and we subtract the whole of the variable components, how much is left to contribute towards meeting our fixed cost? That's all it's saying. So of these profits, okay, let me use the word profits again. How much does it contribute? Okay, contribute. So to meeting these fixed costs. That's it. At the end of the day, we get final profit, which remains for the organization. Okay, so in accounting, somebody would have said this is, let's say, gross profit. Okay, and we would have said this is the net profit in accounting terms. Okay, the same scenario, the same logical reasoning is here from the accounting perspective. Okay, let's compare the absorption costing, which we looked at in the costing techniques, to the marginal costing scenario here. Okay, so for marginal costing, for absorption costing in the first place, you realize that we need to absorb some indirect production overheads in the unit cost of the product. So fixed costs will end up becoming part of the product cost. Okay, for marginal costing, no, that's not what it happens. Marginal costing will only look at the variable cost of production and include it in the activity or in the cost of the product. Why? Because marginal costing is more or less looking at relevant cost. Okay, so we do not include irrelevant cost in the product cost. We only look at only the variable cost. Okay, now the contribution from each production or unit, like I said, contributes towards meeting the fixed cost component of the organization, and then the remaining becomes the real pure cost, pure profit that accrue to the organization. Okay, let's take an example of this. So selling price, we can see selling price is what, 45, and then material cost, which is direct, is 20. We subtract it. Labor cost is 15. We subtract it. Okay, so 45, take out days, you get 0. And you get 4, 2, you get 10, right? You get 10. So at the end of the day, we ask ourselves, if sales level is 6,000, so the sales level is 6,000 units, find the total contribution. So this is our contribution per unit. Total contribution then becomes what? Our 10 multiplied by the 6,000, and we get 60,000. That's our total contribution. So it becomes obvious. Okay, if you want the profit, the pure profit, we just subtract the fixed cost component from it. So we subtract 50 and we end up getting 10K, right? So this becomes our pure profit if we were to compute or find a pure profit. Okay, which of the following statements regarding relevant costs are true? Opportunity cost is a relevant cost, yes. Sunk cost is a relevant, no. Fixed cost will usually be a relevant cost, no. Variable cost will usually be a relevant cost, yes. All right, very easy, straightforward. Okay, let's take a typical contribution analysis in details. Okay, let's look at it in detail. Contribution per unit, contribution per limited resource. So sometimes we'll be having limited resources like labor and then materials. How do we prioritize the products and service so that we can make the highest profit or the highest contribution? Okay, take a simple example. We have sales to be 200. We subtract the whole of variable, direct. Okay, so we subtract the whole of these direct costs. Okay, these direct costs. Now at the end of the day, what do we get? 200 minus 60 minus 40, 110, we get 90. We get 90. The same applies to this angle. Do the same analysis and you get 105. If you look at the contribution per unit, you realize that this is highest. Okay, this is highest. So we'll produce more of this. That's why we rank this 1. And we'll produce less of this if we are to pick anything in terms of ranking. So we would have produced product B per demand before we concentrate on product A if we are using contribution per unit. What if we have limited resource? So look at the scenario where we have just 1050 hours. Remember, product A uses 2 hours per unit. Product B uses 3 hours per unit. Find the contribution per unit by simply dividing this by the 2, and then you end up getting what? 45. And divide this by the 3, and you end up getting 35. In terms of contribution per limiting factor, you realize that this is giving us a higher amount, okay? and this is giving us a lower amount. So we would end up producing more of this before we consider this, if any demand for products come. Okay, so let's assume that for the scenario we've done, we've been given this order. So customers are demanding 500 of product A, 400 of product B. Because of limiting or limited resource, we are going to use contribution per limiting factor. We produce more of this or all of that. So what I will do is that, being a prudent manager, I will end up producing all the 500. So assign all the 500 units to product A and sell them, okay, get them out, okay. So we have 500 units. They take how many? 2 hours per unit, okay. So multiply the 500 by the 2 hours per unit, and we get 1,000. Remember, we had only 1050 hours of skilled labor. So if we take out 1,000, it will be left with 50. So of these 50 hours left, we then assign it to product B. Remember, product B uses 3 hours per unit, and we had only 50 hours. It means for the 50 hours and 3 hours, we end up producing approximately 16 units. So for product A, we give them everything. Product B, unfortunately, we cannot, because we have limited hours or skilled labor resource to use. So that's what happens. Okay, let's take another example where we have a limiting factor of materials, 1090. Okay, product A, we have an order of 470. How many units of product B can we produce? Assuming we are using contribution per limiting factor. So very easy. We have our selling price, 100. Take out our direct variable cost, okay? And then we are being told that product A will use 2 kilograms per unit and product B will use 3 kilograms per unit. What do we do? Okay, assuming these are all the information we have, okay? So 100 less 40, 120 less 40. So we get 60 and 80 as contribution, okay? We get 60, okay, 60 and 80. So product 1A would be, in terms of contribution per unit, would be the second to be ranked. But for product B, in terms of contribution per unit, will be 80. But what if we are using the limiting factor in our analysis? So we divide this by this, okay? And then we get 30. But when we divide the 80 by this, we get 26.6. So in which case, we'll end up producing all or more of this before we consider this guy. Okay. So for product A, we had 470, which has been required or requested by customers. They demand it. So we try to strike this through to the total number of kilograms used, and we get 940. Remember, our limiting factor was what? 1090. Okay, so 1090. So if we have 1090 and we subtract our 940, we get 150 left. So we then have to assign this 150 to product B. Okay, 150 kilograms. Let me be specific. So divide this 150 kilograms, okay, by the 3, and then you end up getting 50 units to be produced for product B. All right, quite interesting and straightforward. Okay, operating gearing, don't confuse it with financial gearing. Financial gearing is quite different altogether in terms of where we're looking at the long-term loans or long-term capital in its proportion to the overall equity or funding base of the organization. That's different. So operating gearing looks at a mix of fixed and variable costs in the business cost structure. A business will have a high operating gearing if it has high levels of fixed costs relative to its variable costs. And operating gearing determines the sensitivity of products to changes in sales level. Operating gearing tends to depend on the industry in which business operates. And it is quite clear, any labor-intensive industry will rely more on labor, variable cost, but low on fixed cost. And any capital-intensive will rely more on fixed cost, but less on variable cost. Okay. So let's take an example. I'll pick the first section, and then based on the second part, you can just use the theory from what we looked in the previous slide to answer this. Okay, so a business has sales of 540. Okay, so sales of 540, that's the sales. Okay, variable cost is 220, fixed cost is 100. Operating gearing factor for the business. Okay, so in calculating it, first subtract the variable cost component of what, 220 from this. What do you get? 540 less 220. I'm sure you get 0, 2, 3, 320, right? You get 320. And then find a similar scenario where we include the total fixed cost into it. Okay, so it will be 540 less the variable cost of 220 less the fixed cost of 100. Okay, so you end up getting 320 from this, so you get 220. So we're looking at the proportion or scenario where we only look at only variable cost to sales. Okay, and where we look at both variable cost and fixed cost to sales. Okay, to our revenue structure. And then once we find this, try and then do a simple ratio and proportion. So of our 320, okay, divided by our 220, and you get our factor. So if you do, you will roughly get 1.454545 onwards. So roughly you get an answer of 1.45 or 46. So roughly this one. Okay, perfect. All right, let's go on. So break-even analysis is a point where we make all our contribution will clear the fixed cost. So zero profit. Okay, so for break-even analysis, all we are talking about is zero profit or loss. We don't make any profit, we don't make any loss. Okay, we recall our cost behaviors. The fixed cost, regardless of production, it remains fixed. Variable, it changes in line with activity level. Okay, so for break even, we are looking at where our contribution will clear all the fixed cost. Okay, our contribution will clear all the fixed cost, with the formula being fixed cost divided by number of units. Okay, contribution per unit. Margin of safety, by its name, tells us that there's a buffer zone. Okay, so more or less I will use a word like a buffer zone where there is the safety of making profit. Okay, safety of making profit. So we end up making profit. So usually it is a current sales unit minus a zero profit unit, profit level. Okay, break even is zero. So if we are able to make more, okay, let's say we have 600 and this is 400, it means we have 200 we can sell to make what? To make profit. All right. Target profit simply is telling us that if we are budgeted to make a certain amount of profit, how do we make it? Okay. So for the how do we make it? By selling how many units to clear it. So target profit simply tells us that let us add the profits. Okay. The break even, which is zero, add the profit to it. Simply that is it. So if you know the break even formula, you just add a profit component to it. So what you get is that break even is saying the fixed cost divided by what? The contribution per unit. So we just add our target profit to it. Okay, target profit. If managers want to make 10,000 and they know that break even is zero plus 10,000. Okay, that's it. We'll look at examples. So let's take a typical example. We have sales per unit contribution will give us the sales per unit less the direct labor, direct material, and direct labor. So 108 less these two gives us 64. Easy, right? Now break even is simply telling us that these 64, how many units should we sell to be able to make 14,000 fixed cost? That's all they are saying. So if you know the number of units, you multiply by this, and then it will give you exactly 14,000 to clear the fixed cost, okay? That's why you find the formula to be what? 14,000, the fixed cost, divided by contribution per unit. And it gives you the unit you need to sell, okay? So you realize that you end up making 219. Multiply the 219, okay? Multiply the 219 to 64, and you get exactly 14,000. That's so easy, very easy, okay? Margin of safety is saying that assuming we were selling 500, they said if we sell 219, we make what? 0 profit. Assuming we were selling, we made 500 sales. What do we get? So realize that if we are making 500 sales, so interesting, we're going to make extra 281. And that gives us a safety zone where we can sell and make more profit. So express the 281 as a percentage of 500 and get 56. So 56% buffer zone where we make enough profit. What about target profit? We want to make a target profit of this. Simply, it says that the break-even point add 25,000 to it. That's it. And how do we get our break-even? So our break-even point is our fixed cost divided by the CPU, okay, contribution per unit. Simply add your target profit. That's it. And then do your simple maths. So realize that what do we get? Fixed cost was what? 14,000. What is the target profit? 25,000. And what is our CPU? 64. So we get 39, okay, that's it, 39 divided by 64, and it means we need to sell 610 units to be able to make a target profit, which management expects of us, of 25,000. Very easy, okay. You can then construct your marginal costing statement using 500 units which we sold, and you end up making these numbers, okay. You can also decide to go using the contribution per unit, so still 108. You plug in 24, you plug in 20, get your answer, okay, of your 64, okay? So you get your 64. Then multiply by 500. What do you get? You should get an answer of this. Very easy. And then this should now cover our total fixed cost, and then we get our pure profit. We get our pure profit or retained profit. Okay, very easy. Okay. So take a typical example of this. You can easily work it, okay? 100 minus 25 minus 15 will give you the contribution per unit. Then divide the 40,000 by the answer contribution per unit will give you the number of units you need to sell to break even. The same scenario is given, assume we want a target profit of 80,000. It's simply our break-even point formula, okay, which is fixed cost divided by a contribution per unit plus the 80,000 gives us the number of units we need to sell. Okay, very easy and quite straightforward. Okay, so that's it for now. You will get into the next section in a bit. All right, see you and take care.